Good afternoon, my dear dudes and dudettes. This is, of course, your guy, Light Liger here, as always. And today, we are going to be talking about Ethereum and the upcoming London hard fork, which is going to be taking place this July. And today, we have reached a new all-time high for Ethereum, which was roughly 5 hours ago at $4,165. And currently we are sitting roughly on $4,112. When you look at like the 1 month or 7-day chart or even 3-month charts, there has been kind of like a slow climb up, and we have been slowly climbing up on that price, especially the last month here. And Bitcoin has been losing its dominance. I think we're going to be seeing the newest low point during this bull run for Bitcoin, where it might be going below 30% dominance, and Ethereum might be hitting over 30%. So it's going to be very interesting what those numbers are going to be looking at the peak. But obviously, the London hard fork is happening, and people are wondering, well, what is that going to be doing to the price and the gas fees and everything? What basically should I know? Am I too late to invest right now and everything, etc.? So those are the questions we're going to be addressing here today and kind of exploring what are exactly those changes which are going to be happening on the London hard fork. So the current supply of Ethereum is 115 million. That is roughly around 5 times the amount of Bitcoin max cap, which is not reached yet, by the way. So that's the number we're going to be getting back to later. But let's kind of talk about the gas fees as of right now first. And that's obviously really crazy right now. If you're going to be buying Ethereum, which I do recommend, is probably through an exchange, Coinbase, Binance, Gate, whatever, and put it into some type of a place where you can gain interest on it. We have covered a lot of those on the channel in the past, but right now buying it on a DEX, Uniswap, or something like that, don't really recommend it. Uniswap trade is currently costing like $250, so definitely not worth interacting with DeFi right now because the gas fees are very, very high. Not too long ago, we were at 15, and now we have basically, well, gone quite up since then, 20x. Now, what are the things that are going to be happening on the London hard fork? So there's basically 2 big changes. One is talked a lot, you might have heard about it before, which is Ape 1559. And then there's another Ape, which is not so much talked about, which we're also going to be discussing here today. And what is basically Ape 1559 going to be doing? So the brief rundown, the TLDR, is that when the transaction happens, you interact with DeFi, you send tokens, Ethereum, claim, anything. There is going to be a thing called base fee, and then there's going to be inclusion fee. This inclusion fee will go to the miners, and the base fee will be burned, okay? This means, theoretically, depending on the amount of transactions happening on the blockchain, there can be more Ethereum burned than there is going to be minted per year. We're going to be getting a bit later into this theories about deflation, what type of behavior it has on blockchain. I'm going to be showing you some data regarding that. And so this basically means that, yes, we might see a lot of price appreciation for the Ethereum due to the fact that it becomes deflating, meaning the supply, becomes can become scarce, or the inflation curve is going to be becoming a lot smaller than it was previously. Obviously, the curve of Ethereum inflation is already going down a lot, kind of like Doge and Monero. So they're already they have deflated every curve, and they don't have a max supply. So at some point, maybe not this year or the next, but at some point, once the rewards per block are going down enough, we can expect that the deflation will take over, and at that point, we're going to be seeing more deflation than actually minting of the Ethereum. And also, we're going to be seeing increased block sizes, which are more now dynamic, meaning that 2 times current gas limits. So this could basically mean during a peak time hour like this, where we saw 300 or 400, it would be a 200 gray instead. But there's other metrics we have to also talk about, which go into the potential values of the gas. Obviously, gas is also determined by how many transactions are going to be taking place. one point I really want to make here is that there's always a potential that when asset becomes deflating, or there is an actually mechanism where the store value becomes to play the term, it means that there's going to be less amount of people using it and more holding it. I have seen this with Bitcoin, where a lot of people have built certain platforms where people do Bitcoin donations and stuff like that, and people are not doing it for two reasons. One, the tipping $5 in Bitcoin to somebody is going to be costing you $13. The second point is people believe in the appreciative store value for Bitcoin, so they don't want to tip it away. And this has been the case with Ethereum, and this makes me believe that we're going to be seeing a lot less transactions happening on all dApps across the board for Ethereum because of this change, and just people don't want to spend it because they believe it will become more deflating and more valuable down the line. The next point we're going to be talking about is, let me actually open this up here. So this was a tweet by Dim Bako. I think he is a core developer on Ethereum, and he talks about here 159. This is actually a bit older, but another very interesting ape that doesn't really get talked about is the tweet 298. And this is disabling gas refunds. This doesn't take a lot of actually talk. I'm not 100% sure, is this going to be slated for London? I'm pretty sure it will be. And there's a lot of things behind this ape that actually is going to be improving the gas fees, and I'm going to be explaining that in a second. So here's a bit of a talk about the ape 3298. And basically, this has to do with gas tokens. And gas tokens are basically things that, well, 1inch uses. They're probably the most popular example. So basically using your gas tokens can reduce the gas cost of the transaction, where the gas is not paid on Ethereum, but with the gas token itself. And they haven't really like super taken off on Ethereum. I think there's a couple of gas tokens that exist, and very few dApps that basically use this. People have like opted out just going for layer 2 instead. And this has created some type of a minting process, which we're going to be touching upon. I had a video about this. This has to do with 1inch's Chi token, which is the gas token. Now, the Chi is very simple model. You can go into the contract, and basically you can mint more tokens. Okay, you go right contract, and here should be a yeah, there's the mint. So I can basically mint Chi tokens, and I will bang that in gas. Okay, so basically let's hypothetically say I'm gonna be minting 200 Chi tokens, and doing when the GUI was 15 GUI, probably you could have like minted Chi tokens like maybe for $10 in gas, you could have gotten like 100 Chi tokens. But right now, when the gas is like 300 GUI, means that you're probably gonna be paying $50 to, you know, mint one. So the idea behind this was people were minting gas tokens when the gases were very low, and then they were selling those gas tokens when the gas fees were really, really high. So when we look at like Chi token here, and I probably should have done this myself, this is the 7-day chart, and as you can see, like a 1-day chart, it's slowly climbing up in here because the gas fees are really high again. So people were minting the Chi token when it was worth like $1 or $2, and when the gas fees go up again, people are going to be selling these Chi tokens a much higher price. And obviously there's, you know, a couple of curves here where they were really, really, I don't remember what was the gas fees during the end of April. Probably then it was at same prices, and I think the gas token price will go for Chi back to like $6-5 because people are seeing the congestion right now on the network again. Now, as a final point I want to talk about here, so just like the long story short is that this is sort of a abusive mechanism which has created bots minting these tokens and created extra congestion on the network. Once the gas tokens are going to be nulled, so they can't be used anymore, that's going to be reducing the gas loads on the network overall. Then I lastly want to talk about BOM. BOM was the very first deflating token in crypto, and I was kind of like part of the deflating wave back in 2019. I had one deflating project on Ethereum back then, and I was participating and doing videos about deflating tokens a lot during that time period. Obviously, the trend kind of died off. Now it has kind of picked up again with all types of other tokenomics models which have introduced burning systems. And the idea behind bomb is basically every time you send it, 1% will basically be burned, but there's no decimals basically on bomb, so technically you're always going to be, you know, deflating one bomb. And it went to above like $10 at some point, and that was like the all-time high for it. Now it's at $4. It was really long time at like, let me actually open the chart. I think for a very long period of time it was below $1, very, very low prices. And it recently has kind of gained up again. They had made a wrapped version which can be traded on Uniswap and etc., which is not deflating. But the thing is, the supply was at 1 million. And in kind of like these 2 last years, it has only burned less than 10% of its supply, and significant amount of that bomb was burned on like the first month or something. If we go into the amount of transactions again here, which gives us a rough amount, there was basically, when here we had, 6,000 transactions happening on February, and thousands of transactions happening in June, and ever since, it has not reached those amounts of burns. So what the TLDR here is, what happened with these deflating tokens is that they never really started to deflate to their ending point. Like even no coin managed to deflate themselves back to the 10% of their supply or even half. So the deflation ended up being super, super small. And it just created this hoarding culture. And that's not something you want for a token that is supposedly supposed to be used on transactions on the blockchain, on smart contracts. So there's going to be less interactions on all dApps across the board, and Ethereum will transition to be more like Bitcoin, which just has a smart contract capability top of it, and might be just used by banks and institutions, and all the transactions basically are going to be happening on layer 2s, and layer 2s, as some people already know, don't have that same layer of security as the mainnet has in terms of hashing and stuff like that. So the layer 2s don't benefit from the security benefits of the mainnet Ethereum. So my prediction is as follows. It will become kind of like Bitcoin. It might see 10K. It would need to go around 12K if I remember right in order to flip Bitcoin and become the largest cryptocurrency. But it have to be understood that this is not like the most ideal situation for Ethereum to have this deflation. We have to see how much percentage-wise deflation we're going to be seeing on the supply, and it's going to be taking some months to see that action taking place. Will it become negative or positive still with the Ethereum being minted? But this is going to be having a positive effect on the price, but not positive effect on the ecosystem, or let's say for miners, because they will be getting less mining fees if the transactions are going to be getting lessened, since people will start hoarding Ethereum instead, seeing it as a store of value rather than a token that is going to be used for dApps. So I predict that this is a good financial investment, but I still am standing by my statement that Ethereum eventually will be taken over by these other smart contract blockchains, because they don't need to use layer 2s, and their main layers are much more scaling, and they don't have all of these problems basically that Ethereum has right now. And also they don't have this deflating model, which is not exactly like great for usage, but it's great for price. So that's something that was a bit of an oversight on perhaps on the developer team for an actual solution. I would have maybe distributed those base fees into a staking pool or something like that instead, but hey, that's their or treasury would have been actually the best decision. But this is my prediction. I think 10K for Ethereum for this run is definitely on the table, hoping for that to happen because I still hold a lot of Ethereum. Obviously, you want to support my work, please drop some Ethereum to this address or some other tokens, or you can drop me Doge or whatever. Thanks for watching. Make sure to subscribe, like, and etc. We'll be seeing you on the next video.